Howdy there, folks. We got to talk, okay? We got to talk about, is this the end? We just came off of one of the strongest weeks, actually the strongest week in the stock market we've had since 2020. I mean, absolutely outstanding as far as the indexes, as far as countless stocks. And I put a bunch of slides together for you guys here today. We're going to go through this. We're going to talk about this. Is this the end of the, let's call it the market crash we've been in, which recently, as of last week, literally, we had NASDAQ in bear market. And we had the Russell in bear market. A lot of the European markets have all been in bear market as well. And other indexes have been in correction. So it's been rough out there. But yeah, another day, green everywhere across the board. Just green, green, green. A lot of massive moves out there today. Beyond Meat, 9%. Oatly 8%, the Planet's 5.5%, Voyager's up about 6%, Smile Direct Club's having a great day, Revolve. I mean, if I just look at the stocks I own, there's a lot of green out there, and it's been a lot of green all week. It's been a beautiful week, let's put it that way, especially these last 4 days. PayPal 3%. PayPal was in the 90s a few days ago. It's just ridiculous. If we look at stocks I'm watching, but I don't currently own, some of these moves are epic. SoFi, 11.6%, which SoFi, for some of this rally, seemed like it was sitting out. But not today. Not today. SoFi woke up. Teladoc, over 7%. That's a telehealth company. Square's about a 7% move. Or Upwork, huge move. I mean, just huge moves across the board. Palantir, about a 3% move. Shopify, 2.7% there. Look at this. This is, whoa, okay? Shopify's up 25%. This week, okay, no earnings, no nothing, no news, but, you know, and this is something I've been trying to explain to folks the last, let's say, month, is when you get that turn in the market, in a devastated market, I mean, the moves are insane when you start coming out of that situation, and that's exactly what we're seeing play out with a Shopify at 25% move. But what if I told you that's just the tip of the iceberg, okay? Look at Teladoc. This week, the stock is up on a 5-day, okay, on a 5-day, 36%. No earnings, no news, no nothing, okay? 36%. But we're still in child's play territory, okay? That's nothing. Look at Square stock. Oh my gosh. Square stock on a 5-day, 44.8%. No earnings, no news, nothing, okay? That's just pure buying momentum and, you know, running out of sellers and just a lot of folks just coming in and some big money coming in and buying up that stock, right? Almost a 45% move on a 5-day. That's epic, okay? But the stock had been heavily damaged, right? The selling pressure has been immense for months in the stock, and that just ended in a snap of fingers, right? Look at JD, a Chinese company, e-commerce company, 50% in the last 5 days, man. These moves are crazy, crazy. Look at Neo stock, 45%. This is what happens when, you know, a lot of these stocks just get far oversold. I mean, it just takes a little bit of buying pressure to come in, and next thing you know, they're up 30, 40, 50% moves. Smile Direct Club, 34% in a 5-day span. Just some insane moves. Look at Beyond Meat, BYND, 36% in 5 days, right? So, nonetheless, great week in the market, great week for the indexes, specifically over the past 4 days, and a great week for just countless stocks. The amount of stocks I know of or personally own that were up anywhere between 15% and 40%, basically from Tuesday to Friday is just ridiculous, okay? Now, with that being said, now that we understand, obviously stocks are in beasting right now. Is this going to continue? You know, how do I kind of look at this? So I showed this, I probably showed this about last week, maybe even on the same day last week, essentially, okay? And what this shows you is sentiment over time, right? And what I brought out in that video, for those that didn't get to see it, is whenever you have these time periods where you have major spikes down under this green line, which means the market is just far too bearish, very shortly after, usually within weeks or months of that, you usually get a massive kind of bull rally in the actual indexes. And it plays out every single time like that. Every single time you get a lot of spikes in a period, it's a great buy the dip opportunity. And recently we've had a lot of spikes under that line, usually a great opportunity, right? Usually if you're up here above the red line, you're way too bullish. This is AAII sentiment, which shows you investor sentiment in the market. And if they're feeling like bullish on the market, right? Over the next 6 months, bearish or kind of in between. And so if you get a ton of spikes all, way up here, sometimes you want to lay off a buying a little bit. It doesn't work perfectly, but it's pretty darn close actually, okay? And if you get a lot of spikes, basically below that line, it's usually a pretty good sign. It's one of just many indicators to kind of show you the sentiment of the market. And like I said, usually you're going to be able to follow the indexes exactly there, because almost always, whenever there's all those spikes, under that line, essentially, that basically means you are far too bearish on the market and you're due for likely a big rally. And like I said, when you get a ton of spikes above that, you're also usually due for kind of a market drop. Let's call it that, okay? So that's first part, right? That's really good news. The market's been extremely bearish, and we're starting to flip some people, especially after a week like this, to the bullish side. It's very clear in the pricing action, right? This is more important, though, in my opinion. And this I brought out in a video about a week ago or so. And basically, if you look at the past 20, basically my entire life of being in the stock market, not just me being in the stock market, but me being alive. This goes all the way back to, I think I pulled it back to 1990, and I was born in 1989, okay? Basically, what you're going to find is over time, in terms of the major drops in the market, they don't last too long. And even the most vicious ones, right? The tech bubble lasted a really long time. That was about a 2.5-year drop there. That was just vicious, right? Stocks got massively overvalued, and a lot of companies just didn't even have business models. It was a joke time, right? And so that was a long time to bottom, 2.5 years. If you look at the Great Recession, which was the closest thing we've had since the Great Depression in the United States of America, there was about a 1.5-year drop to the bottom, right? Peak to trough. So 1.5 years, that's a long time, right? But also do keep in mind, we almost lost the entire financial system in all the big banks during that time period, okay? So it was an extraordinary time period. Now, if we look at all these blue dips here, all those lasted less than 6 months. All of those. So in terms of a major drawdown in the market, it's very rare, and I mean very rare, that you get a market to continue to drop for more than 6 months. Almost always it is far less than 6 months. And if we look at the market, right, when did the market start to drop? The market started to drop, obviously, it was in November, right? And the Russell and a lot of the smaller cap stocks, right at the very beginning of November, they started to drop, okay? NASDAQ followed shortly after, a little later in November. And now here we are. We're in March, right? We're in mid-March right now, right? And so the market is in this kind of time period where it's like, okay, baby, it's time. It's about time to flip, right? Or we're going to have a great, financial collapse type situation where the market goes down for like a year and a half straight or something like that. That's a fairly low probability. It's always a possibility in the market, and we have to accept that, but it's a pretty low probability, especially if you look at the way the capital system's structured right now. If you look at balance sheets, if you look at where companies are at, if you look at the overall economy, things like that, it's a possibility that you could go through some massive recession. I'm talking massive, but it's a fairly low probability. So if you have that low probability and you don't have anything concrete to go off of other than, well, it might happen, then you're stuck in a situation where it's like, well, shoot, man, maybe that's not happening, and so therefore the market has to bounce, because these sorts of time periods are not normal. Let's call it that. When the market's been dropping for 4+ months, basically just an onslaught of the market, yeah, we're due for a massive bounce, right? And so NASDAQ peaked out at 16,000 plus, and then last week is trading in the 12s. And so that's first thing to keep in mind. These drops don't last very long. This shows you on even a better scale. This was as of the 14th, so last week we were down 21.6% on the NASDAQ, right? Which the only drops we've had that big, NASDAQ corrections 10% plus, since kind of coming out of the 08-09 crash, right? You had this one, which was vicious. I remember that one, December 2018. It started earlier than that, but December is when it got really ugly. 23.6% is when we hit the lows, and that lasted 117 days. You had the Rona crash where we fell over 30% in 33 days. So that one really was, quick one, right? And obviously a once in a 100-year event. And this one's 21.6% as of last week in 115 days. So basically days long, we were pushing it, right? We were pushing it. It's like, okay, it's about ready to wrap this baby up, right? And as far as the drop there, obviously a very significant drop, the third biggest drop we've had in the markets, right? So that's very important to remember there, right? And if you look at the history of the bull markets since the 40s, if you want to go all the way back to then, right? You notice something. I think a chart like this is extremely important because I think folks they fear the bear markets. They fear the tough market like we've just been through, right? Where you go down viciously 20+% in a matter of 4 months, a little over 4 months. That's painful. But people fear these. But the thing to remember is these time periods are actually a very small blip on the scale. That's what they are. They're a very small blip on the whole radar here. And the fact is, most of the time you are in a massive bull market, right? And it's unfortunate because here's what happens, right? Here's what happens. Retail, a lot of times, buy into these peaks when everything looks great in the market, right? And it's like the market's been beasting and stock's been beasting and everybody's friends and family have been making a lot of money. And so they buy into these peaks, right? And then very shortly after those peaks, everything gets hammered and stocks end up crashing, right? Or going down, correcting, going down 10, 15%, or going into bear market, a 20% plus move, right? And you get this time period, and what does retail usually do? Well, exactly what we've seen retail do, unfortunately. Panic sell out of stocks and just cash everything in sight. And that's just, it's sad. That's the biggest thing I'd say. It's just sad because every single time you get one of these time periods, retail, massively sells, cashes. And when the pain's the worst, that's when they're cashing the most. When all along, the only thing you should be doing is holding, or if you got more money coming in each month than you have bills, right? You put that money in the market and you buy the dip. But unfortunately, it doesn't work like that most of the time for retail. They get scared and they sell out. Now, my audience, obviously you guys watching this, a lot of you guys don't fit to that category. A lot of you guys have been holding strong, or if anything, you've been buying the dip as these stocks have gone down and go down. And so respect to you guys. But I can tell you, you are the minority in this. Let's be very, very clear about this. You are the minority, and most folks have felt like the pain's too much and they cashed out over the last month or so. And that's just unfortunate because the only way that makes sense is if you're going to have some sort of colossal crash where you're down 50%, 60%. But those come so few and far between that that's such a gambling decision. It's not even funny. You can't be banking all the time that the market's going to go down, 50, 60%. Those time periods come very few and far between, right? And especially not in a time where, folks are pretty flush with cash. So, yeah, nonetheless, it's time to buy when retail's kind of panicking out, right? Now, also, let's be very clear about Wall Street. Wall Street's been selling off very heavily up until this week. So let's be very clear about that. It's not only retail. And Wall Street's been very negative on the market. Hedge funds been very negative on the market. And here we are, the best week since 2020. I can tell you, a week like this we just had, this will make Wall Street that is on the sideline wake up a little bit and say, all that money that's sitting on the sideline, what's going on here? Is there something, maybe I should get back in? Or a lot of money's rotated to safety sectors, right? Safety stocks, maybe consumer discretionary, maybe, oil and gas, energy, utilities. I mean, let's be honest. Those aren't the sorts of stocks people want to be in. Let's just be honest. For a very short amount of time, that's where maybe money can flood. But let's not kid ourselves, man. Let's not kid ourselves. They want to freaking own Shopify. They want to own Teladoc. They want to own the growth stocks. Okay? They want to own Amazon. Let's just call it what it is. No one wants to hide out in utilities forever. That can be fine for a few weeks or a few months as Wall Street kind of rotates money, but no one wants to hold those sorts of stocks. Facts, okay? Facts. At the end of the day, what do people want? They want the excitement. They want the growth. They want the companies with the huge 5-year, 10-year out revenue type opportunities, right? They don't want to hide out in some stock that's got 3% revenue growth, some stock that, they got good cash flows, but their revenues are going to be in decline over the coming years. They don't want to be in those. That's a hideout period when the market's shaky. That's all that is. That's a hideout period when the market's shaky. Then the money rotates over back to growth because that's what people actually want. We can call it the way it is, or we can fake it, right? But let's be honest, they want back in those growth babies, okay? And so now Wall Street's gonna have to consider after a week like this, man, maybe I've been a little too conservative. Maybe I got to go over here a little bit, right? And that's exactly what's going to at least be the consideration. And so this upcoming week will be very important when it comes to pricing action to kind of see if Wall Street's going to maybe start piling in here, or if they're kind of like, I don't know about this, right? No, we're going to have a 6-week waiting game, essentially, that's going on. I want to explain exactly how this works, what I'm doing in the market, what I'm up to, those sorts of things. Also, make sure you check out the Hungry Bowl. Basically, we've got our email newsletter, keeps you up to date with everything going on in the business community, with stocks, cryptos, all that stuff. It's absolutely free to sign up for that. Check out Pin Comment. It's amazing. Also, get some free stocks from Moomoo, especially stocks like NEO. They're giving away a free NEO share right now, deposit of any amount. And NEO, I don't know if you've seen that price, but it's been going up quite a bit this week, okay? So, alrighty, let's cover this. So we got a 6-week waiting game now. And we'll get into kind of what I'm up to and things like that in the market. We got a 6-week waiting game. So what does this mean essentially? Well, we just got over earnings season, right? Now, the big companies are going to start reporting earnings again in, you guessed it, 6 weeks, all right? Now, the market's kind of in a little bit of no man's land for the next 6 weeks, which means anything can happen. You could continue to get some massive rallies, you can get some massive sell-offs, you can get some trading activity. But right now, the market doesn't have a lot to go off of for the next 6 weeks because we're waiting on those next earnings, right? Now, this last earnings period was, I would call it shaky. You had some good 4Q numbers, but then you had a lot of companies that guided weak numbers for Q1 for the first half of the year. Some companies that didn't guide at all. And I'm not talking about small companies. I'm talking about big, giant corporations, okay, that didn't give any guidance for the year or any guidance for the quarter. So it was a shaky earnings period. It was shaky. And so now Wall Street and a lot of big money is going to be waiting, kind of saying, okay, let's see what happens with these earnings. What does Apple report in this quarter, right? What does Google have to say in this quarter? Meta, they reported some troubling earnings this last earnings period, specifically with guidance. What do they have to say? PayPal came off back-to-back kind of disappointing quarters. Does PayPal feel better about the year, right? And so Wall Street, a lot of Wall Street is still going to wait out. Even if we do continue to get buying pressure, there's going to be a lot of Wall Street money that still kind of waits out and just says, let me just wait till earnings, see what happens there. Now, if earnings are decently strong, we'll be set up for a lot more rallies as we get into late springtime and into summertime. And I mean a lot more rallies, because that would just kind of be a scenario where it's like, all these recession fears. Well, look at all the companies, because the companies are going to tell you what's going on, right? The companies got the numbers, and if those are a lot of beats, and if their guidance is strong, then that whole recession fear, that brick starts to crumble more and more, right? Now, you say, well, that brings up the Fed a little bit, but everybody expects the Fed to already climb. That's already been priced in the market. Everybody's expecting the Fed to raise rates another 5 to 7 times over the next year. Whether that happens is still a big question, but everybody's expecting pretty much the worst when it comes to the Fed raising rates, okay? And so that's kind of a crumbling brick there, right? Now, in terms of myself, right, I am the most invested in this market I've been since December 2018. You guys know I have went beast mode over the last couple months in the market, right? It really started in December for me. That's when I really started piling in money and then just kept it going. And, I'm pretty much tapped out recently. I'll just put it like that, right? I am the most invested I've been since December 2018. I flooded money into this market like it's nobody's business. There's just countless stocks I see that are great values for a long-term investor like myself. And I understand. I've been on this rodeo many, many times, okay, over a 14-year span. And I've seen it time and time again, right? You can't always count on the 50% crash. That's just not realistic. And so if I see the market pull back into bear market, 20% plus, if I see the sentiment go that negative, and I see countless deals in the market, that stocks that I think are going to 2x, 3x, 4x over the coming years, and those stocks are trading for what I feel is a quarter on the dollar, I've got to go ahead and I've got to buy those stocks heavily. And yeah, sometimes I maybe deploy a little bit too fast, right? And I don't buy at the exact bottom, but man, I deploy heavily. And that's exactly what I've done. And as far as myself kind of moving forward, I plan to continue to invest heavily in this market in 22. And the reason being is a lot of these stocks, even if they continue to come back, a lot of them are still down significantly. A lot of these stocks honestly need to go up another 50 to 70% from here for me to say, you know what, I'm going to pull back now. I'm going to start cashing up again. That's the thing. So we're a long way from that. We would need in my opinion, we would need a multi-month rally, meaning we rally month after month after month for me to say, okay, I'm going to start pulling back now. I'm going to start cashing up a little bit, right? So for me, I'm going to likely continue to be an aggressive investor for the next 3 to 6 months, I would call it. unless, the market comes back so fast that, all these stocks are like, wow, they all doubled up or something like that, or tripled up. And then it's like, okay, maybe it's not as attractive. So outside of that scenario, I'm going to continue to just be a buyer over the coming months. And so that's where I'm at in the market. So in my opinion, I don't think we can call the crash over yet, or this is the end of our bear market. We're technically out of bear market territory now on the Russell and the NASDAQ. So that's good news. But we can't say it's completely over yet, because we got to admit that a lot of Wall Street money really dictates how this market moves, right? And a lot of them are still going to be skeptical. They're still going to be skeptical. There's definitely going to be a good amount of them that are kind of on this waiting game, right? And kind of waiting for next earnings. And I'm super excited for the next earnings. That can't come fast enough. That 6 weeks, that can't come fast enough, in my opinion, because I'm looking at it and I'm like, I want to hear what these companies have to say, because with all those recession fears we had for a little bit there, right? If companies just got it like that and they report some really strong numbers, then those fears just start to subside in a massive, massive way. On the flip side, though, if they did report troubling numbers, that could accelerate those fears. And I think that's why a lot of Wall Street money is going to probably end up waiting out this. And a lot of Wall Street, the way they're going to look at this is they're like, okay, maybe we wait out a 5% move in the S&P 500, right? That's the way they'll look at it. They'll say, well, maybe we'll miss a 5% move in the S&P 500, but that's better than, if companies report horrible numbers and the S&P 500 goes down 10, 15, 20%. Imagine Apple reported bad numbers, Microsoft, and we had to go down big because of those big dogs, right? So that's, I think, the way the market kind of looks at it. So that's my video, guys. I hope you enjoyed it. I appreciate you joining me. Much love as always. Don't forget to subscribe and smash, as always, part of the Smash Squad. Appreciate you. Check out those pinned comments for that awesome stuff.